Good morning and welcome to our Thursday Q&A session. We haven't had a couple because of all the public holidays that have been that we've had. We're going to try and cover FirstRand, Aspen and Impala today. So we're going to keep the analysts to a short presentation. We're going to run through the technicals and we're going to be really quick to field as many questions as we can. We thank you for your participation. Type your questions as they come up in the chat so that you don't forget later. Once we open the floor for questions, and then we'll deal with as many of them as we possibly can. I'm going to hand over to Pierre to kick us off with FirstRand. Thank you, Pierre.
Thanks, Sarel. Good morning, everyone. So I'll take us through FirstRand. So we'll be looking mainly at the half-year results of FirstRand today. So they have a June year end, so these results will be ending December 2023 last year for those 6 months. So just on a macro, so in the banks, we still see the pressure on the consumers ticking up. We can see credit loss ratios and so forth increasing, but the outlook is changing to a lower interest rate environment with most banks and expectations around the second half of this year. On the results front, the net interest income on FirstRand side benefited mainly on the loan growth and not so much from a higher interest rate where they usually have expanding net interest margins. And that's one key thing that I just want to highlight for FirstRand, so that it's less sensitive to interest rates on the net interest income, so on the net interest margin portions. So why that's important. So if we think about interest rates going lower, it's a bank that should have more resilient earnings on this front going forward. The non-interest revenue had growth, but the prior had a big private equity sale, which lowered the perceived growth that we saw there. And then, as with most banks, the impairments that tick up on FirstRand, but what's quite different on FirstRand side is its credit loss ratio is actually to the lower end of its range compared to other banks which are higher at the moment. And then another main point, this is not necessarily just for FirstRand, but for all the banks at the moment, the valuation multiples are very low at the moment. We have a buy recommendation on FirstRand, and what we change our mind on this is it has a higher PEs and valuation multiples because it is a higher quality bank. It does have, for instance, a higher return on equity ratios and things like that when you compare it to the other main three banks. So if that were to decrease relative to them, and it also has a slightly higher SA exposure to the other banks. So if you favor more, let's say Africa, then you might rather go with the Absa Standard Bank compared to FirstRand. Okay, diving into the results here, we can see that starting from the top, that net interest income grew by 13%. And as I mentioned, this is mainly due to the loans and advances increasing. You can see that average interest earning assets were up 11%. So only that about 2% was due to that net interest margin expanding slightly. The non-interest revenue didn't grow as much. That's due to the private equity. You can see that private equity gross income in that chart, how it was, how large it was in the prior year compared to the current year. And if you look at that grey block, or the light grey block, it was that realizations which was so large, but the annuity income is still increasing and it still has unrealized value left in there. And just the overall revenue was growth was in line with the expenses, slightly better. As you can see, that cost to income ratio slightly improving there. The impairments that ticked up increased 28%. So part of that would be the advances or the loans growing by 10, and then let's say about that the remaining 18% is due to more loans becoming stage 3 loans. So the stage 3 loans increased by 23% compared to your stage 1, which is better quality loans, increasing 11%. So more loans shifting into, let's say, worse credit quality, so having higher impairments on that front. And on that non-interest revenue, just dissecting it a bit, you can see the net fee and commission income, which is the main item, represented by 72% of the non-interest revenue. So they grew their active customers by 5% and the transactional volumes by 7%. But this was offset by sub-inflation fee increases, and that's why they land on the 4% increase. The net insurance income up 10%, and then you will note there that decrease in the gain less loss from investing activities, and that's the private equity investment sales that I was talking about, which had a higher prior year base. So it was at 1.2 billion included in the prior year, which wasn't included in the current year. Expenses front, so expenses are slightly elevated at the moment, increasing 9%. So the total staff-related expenditures, which is about 63%, increased 9%. They had a flat head count, so these increases were mainly annual increases combined with them mentioning also a continued repricing in high in-demand technical skills. So a slightly more expensive employee mix that they also have. On the computer expenses front, so part of the rand devaluing, that would cause also the computer expenses to increase, as some of these are priced in dollars and so forth. And then they also had some higher increased software licensing costs, which they mentioned. So when we look at the share price, how it reacts, so over a 10-year period, FirstRand has outperformed, so over the longer term, and then a bit mixed if you look at the table at the top, but the 3-year graph below, you can see it outperformed slightly, as it also recently took a bit of a dip in from the start of the year. And on a valuation front, so if we look at that price to earnings multiple at the bottom, you can see it's extremely cheap at the moment, considering that it's now where it was last in COVID times. So we have a 90 Rand intrinsic value as FirstRand. It's one of our top big banks that we favor, and therefore have a 47% upside on it. And this is mainly, if you think about three views, these banks are highly provisioned, so ready for if there's impairments, and if there's not impairments coming through, then it's possible releases to the income statement. And then secondly, they price cheaply, so that's also in the price at the moment. And then thirdly, also FirstRand, as mentioned, is a bit more resilient on the net interest income should we look to lower interest rates going forward. Thanks. That's everything from my side. I hand over to Sean now for the technical piece.
Yeah, good morning, everybody. Yeah, you can see the chart there of FirstRand. I see now it was lastly trading nearly 2% up this morning, but it shows that it's both the medium term and the long term trends are bearish, as the share price is trading far below its 21-day and 40-day moving averages, as well as its 200-day moving average. And you also can see there very plainly the shares trading within a down channel and looks set to retest those what I call the support zone. That's between, say, 60 Rand and 58 Rand. So this bearish price action, I think it's, you can see there also at the bottom there, it's confirmed by the both by the MACD indicator and stochastic indicators. They're both trading in oversold territory, but they don't offer any clear bias bullish signals at this point in time. So what needs to be done is the share needs to find support, and I think from there just rally from there and then break up out of that narrow channel, that channel downline or down channel, and then break up above that upper resistance trend line of that down channel, and then move up through all those moving averages, which also present some resistance. So it's trading far below its intrinsic value. You see that right up top there is the resistance trend line around about 75, and our intrinsic value is still way above that. So it's still got a long way to go. So it's a good buy, but I believe it's going to need some patience.
Yeah, I think to just add in there, if you look at the two big hoops that it makes from from bottom to top and then back to bottom and then back to top, and now we're almost at the bottom again. If you look at that, it's one big sideways channel that it's trading in, and certainly correlates with the intrinsic value that PS put up, and the interim resistance levels at $74. If you pick it up around 58, $60, you would probably see this channel continue and go up before it finds proper resistance at 74 on its way up to the intrinsic value. So I just wanted to add that it's in a sideways channel and it's currently at the bottom of that channel. I think we'll jump straight to Ross now to take us through Aspen. Thank you.
Can you hear me?
Yep, perfect, Ross. We can see,
Cool.
we can hear.
Morning, guys. My name's Ross van Coller. I'll be taking you through Aspen, also on the back of first half year results of 2024, similar to FirstRand, which you saw in December. Just to quickly touch on the macroeconomic environment in terms of the healthcare industry, I think over the past 18 months, everyone's sort of seen the weight loss and obesity drugs have dominated the headlines, and subsequently Eli Lilly and Novo Nordisk have flown in the last 12 months to 18 months. But outside of that, the global healthcare industry has quite struggled. We are facing patent cliffs, probably the biggest patent cliff ever in the latter half of this decade. And the thing is with these healthcare industries is jurisdiction to jurisdiction, it's very, very highly regulated. Specifically in Aspen's case, they've got South Africa, which has single exit pricing, which basically caps the pricing you can increase your drugs by. Australia, they have a very similar thing, whereby you have to go onto a government list and thereby subsidies are provided. And the big thing for Aspen in this thing has been in China, where they have a thing called volume-based procurement, which is essentially the Chinese government massively slashing costs of these drugs up to 70-80%. Not only Aspen that's affected, obviously everyone's affected, but Aspen has highlighted that quite often. From a valuation point of view, we do see a bit of a downside from here. Previously, we had an upside of about 11%. That was when the stock was trading closer to 170 Rand. With the recent increase in the share price recently, it's in our opinion, hasn't really justified the valuation. So we do have a slight downside on that. And then quickly, just to touch on the first half revenue results, they did see revenues increase by 10%, but when you adjust that for currency, it was only up 2%. So when they're looking for organic growth of double digits in the commercial pharma space, it does seem a little bit optimistic. Although they do have these contracts that are starting to seep through. They did highlight that towards the end of 2026, they should see about 8 billion rands worth of additions. 500 million of that is coming now. So we should see them the second half of 2024 with the June year end. But on the back of the results, I think we were just hoping to see some more transparency on those. They said they are in negotiations to develop more contracts. And then there is a looming Gavi. Gavi is the Global Alliance for Vaccines and Immunization, started by the Bill and Melinda Gates Foundation. Essentially, what they want to do is they want to bring in contracts for Africa, and we'll all have to be World Health Organization approved, and Aspen is in a good stead there. So we should see some portion of that come through. We're not sure how much yet. It's up to about $1 billion, of which we're not sure how much Aspen will get, but they are hoping to see that soon. Although management is quite frustrated at the slow progress of that, but it is a matter of when, not if. Just to quickly touch on these segments, which has been something which is a little bit of a sore point at the moment for the second time. So that since 2018, they've had 3 different reporting segments. They've just changed it again. So as of going forward from 2024, you'll have the charts on the right compared to previously, which is charts on the left. And essentially, they're just breaking down their commercial pharma division. Used to be sterile focused brands and regional brands. Now it's going to be prescription, over-the-counter, and injectables. The manufacturing segment will stay the same, although there are some changes there. But just to point to the bottom right chart, you can just see how all of this ties into gross profits, with the manufacturing segment Although it occupies almost 30% of the revenue, it's only contributing 3.5% of the gross profit, but I'll touch on that in a second. Historically, Aspen's had a bit of a debt problem. They've had a large amount of acquisitions that have fueled debts, and these acquisitions, there's often a price mismatch in the sense that most of their debt is euro denominated, whereas the majority of their income isn't euro revenue based. So it does create a bit of a problem when you see fluctuating exchange rates. Although in recent times, Aspen's done a very good job of bringing that down. When it was close to 4.5 times net debt to EBITDA, does raise some concerns from a financing point of view. They've gotten that down to about just under 2 times with the recent acquisition of Viatris's portfolio of products. It's probably about 2.4 times, but still within the levels. So we just need to keep an eye on that because management doesn't have a good track record of acquisitions. And when they start going on this escapade, you need to just pay a bit of attention. This I took from the presentation. I thought it was quite a nice little chart just so you can see where Aspen has come from, where they're going, and what's affecting their earnings. As I mentioned, the Chinese volume-based procurement was a problem. Chinese basically take the contracts and say, if you want to do business with us, here are the prices, cut it by this much. The Russian COVID sales now falling off, so that's a positive. And then they've just struck deals with Latin America. That's the Viatris and Sandoz in China. So we should see 1.5 billion coming from that from Sandoz, and then the additional 3.5 billion in the sterile contracts, which you can see right at the bottom from the manufacturing side of things. Just to touch on the heparin quite quickly, they basically built up a large inventory base of heparin under exceeding demand, which turned to exceeding supply, and they ended up having to sell a lot of this at below cost. That's why the manufacturing margins are so low. It should normalize more to the 10% gross profit margins, but I think it's still going to take a year to unwind all that inventory. To quickly touch on peer comparison, I'm not going to spend too long on this because Aspen doesn't really have many like-to-like peers. The only one in South Africa is Adcock, and even then it's not a like-for-like substitution. So we look more offshore at Bayer and Viatris, which are similar industries and manufacturing producers. So you can see Aspen does trade a little bit above those, but compared to their own multiples, historically does trade higher than their offshore peers. And at the moment, we're just seeing it's a little bit stretched from an EV to EBITDA point of view. So a more normalization towards the 9-8 times would be more fair in our opinion. And if we just turn over to how I got to here, it was basically a forecast of EBITDA for 2025. I'm slightly below consensus. I just don't think that the margin recovery that the other analysts are forecasting is obtainable in the next 15 months. I think it's going to come in a little bit slower. I think that heparin unwind is going to take a little bit longer than they're expecting. So on a base case of 8 times EBITDA, and then weighting the bear and the bull case, us having 10% downside, anything below 190, 180 will start looking attractive, and we will start having more of a look at. And I'll just turn over to the technicals from Sean.
Yeah, okay. So you can see the chart there of Aspen's, a bit of the opposite to FirstRand. You can see it's trading with a narrow up channel. So yeah, it's staying also far above its moving averages. So it's all very bullish. In the shorter term, you can see at the bottom there 2 technical indicators. They're more on the top of the cycle. So it's a bit more overbought and coming very close to giving some sell signals very soon. So I anticipate the share price to pull back. I saw it was a bit volatile this morning. About half an hour ago, it was down 0.11%, and now it's up 0.49%. So it's quite volatile, but it's creating what we call a bit of a doji there. So it's a bit of uncertainty on the share price. So yeah, I'll wait for a confirmation and breakout of that lower support trend line. We could expect the share price maybe to pull back to that resistance trend line around about that 205 level. That previous resistance, which will now be the new support, if that doesn't hold, we can anticipate the share price to pull way back to that's supported with 190, which is very close to what Ross said now is our intrinsic value at 196. So yeah, that's how we see it at the moment. So a bit more toppish on this share and anticipate some selling come soon.
Yeah, it's a very strong bull spike that. And it has broken out of, if you think of what I said on FirstRand, this was also in a big sideways channel, has now broken up. It typically does come back to touch the levels at which it broke out. So those 204 levels of Sean might come into play. But you might even see a break back into the channel before it goes up, sort of retracing to the intrinsic values that Ross has added there. Okay, so I'm going to jump over to Impala and very quickly just highlight what Matt has said on Impala. Can you see my screen, guys? Sean? Okay, right. So on Impala, we have got Impala with an intrinsic value of $85. Matt has compared it to, has had a look at the PGM prices. And if you look at these graphs, they really look tired. I mean, platinum price is very flat. Palladium price has come down and sort of flattening out. And obviously rhodium has flattened out. And these stocks rely heavily on the prices of these metals to make money. Throw into that into the mix. This is a basket price where they have 50% platinum, 40% palladium, 7% rhodium, and 3% gold. And you'll see that Impala on that basis compared to the basket sitting right at the bottom from a valuation point of view. If you look at them compared to the resources index, then you see Impala and Sibanye both sitting in the bottom third of things, with stuff like Harmony, on which we recently had a sell recommendation, sitting right at the top. So not yet time to buy necessarily, but maybe time for a small nibble in Impala and in Sibanye. And then if you look at the results highlights, yes, they increased their refined production by 19%, but the revenue decreased by 25%. The rand didn't help them much because the rand weakened, and obviously these things are priced in dollar. But it still leaves them with a hefty amount of cash of 5.2 billion after the Royal Bafokeng Plat acquisition. So it's a good company sitting on a lot of cash, just being suppressed by low metals prices, which they rely on. Easing interest rates might benefit them. Internal combustion engines aren't dead, in my view. Hybrid engine growth we've seen in car manufacturers, guys trying to steer slightly away from going all out electric. The valuation that Matt did, this is the way he got about his valuation, and he's saying that the current share price at 76 is maybe a little bit low for Impala, and the intrinsic value that he places on it is $85. If we hop to the technical that Sean added to this last week, you can see that it's really at the bottom here and slightly picking up its head. No great shakes, but I would wait for a slight pullback and then definitely nibble on Impala, as it's a good company sitting on a lot of cash. And that's all I wanted to highlight today. So we're going to jump straight to questions and answers. I'm not going to keep myself clever and try being the analyst here. Because I just read Matt's presentation, but I think you guys can fire away your questions at Pierre and Ross, and let's see if there's anything in the chat there. We haven't got any questions in the chat yet. Does anybody want to ask a question outright? Just switch on your camera and your mic and then direct it at myself, Sean, Pierre, or Ross. Doesn't look like it. Can everybody hear us?
We can hear you.
Yes,
Thanks,
Clive,
Sarah.
go for it. Have you got a question?
No comments, but thanks for your awesome presentations.
Thank you very much,
Always appreciated.
Thanks for that comment. Okay, I don't see any other questions popping up. So to summarize, Pierre's saying that FirstRand has become really cheap. It may become slightly more cheap if you listen to what Sean said, down to about $58, but definitely a stock that's probably happier around the 70 mark, with a possible upside to $90. Ross is saying that Aspen is slightly expensive at the moment after its recent run, and we're expecting it to pull back slightly. If you haven't got Aspen, then you can maybe have a dip if it pulls back to around the 195 levels or 190 levels. And then Impala, we're also saying that it's sitting at the bottom of all these platinum metal companies. It's being hit a little bit hard in our opinion, and that may also be worth a nibble if you're looking for something to buy. I don't see any other questions. I know it was an information overload today with trying to cover all three stocks. Sean, do you know what's up next week? You muted, mate.
It's Nedbank. It's
Nedbank and it's Pierre. Fantastic. So we've got Pierre back with us next week, and we'll discuss Nedbank, and it'll be nice to compare the two side to side, FirstRand and Nedbank, next week. Richard says, thanks for the presentation. Gert says, thanks, guys. I thank you for your attendance. Thank you, guys, for your insights, Ross and Pierre. It's really nice to hear what these companies do, how they do their business, and how we see the fundamental side of things pushing them forward and affecting the share prices. Thanks for sharing your insights with us. We'll get together next week, Thursday, same time, same place, and we'll be talking Nedbank. Have a fantastic day. Cheers.
Cheers, guys. Thanks.